Hello there, welcome back to my channel. In this video, I want to look at a question on November 2024. That is on the preparation of the statement of comprehensive income, and this is our paper one. So I'm going to a question. It's question one, and it's on company financial statement. So our question has got 55 marks and requires you to spend on average 45 minutes. So the question is the information relates to Ivory Park Limited for the year ended 29th February 2024. So all the required parts we are given the first part is leads us to calculate depreciation on equipment on 29th February 2024 with 2 marks, and also cost price of vehicles on 29th February 2024 with 4 marks, depreciation on vehicles on 29th February 2024 with 5 marks. And lastly, we have got a profit or loss on vehicle traded in on 1 September 2023 per month. So going to the information that we are given, we see that we're given information A, whereby we are given the balances or total amounts. We are given balance or totals among others that appear in the books on. We are given at the end of the previous year, that is at 20th February 2023, and then the current year is ending 29th February 2024. So with that, we see that we've got additional information that we are given in terms of adjustment number B, where we have got a fixed assets, equipment, information on vehicles that we just need to browse through before you start to answer the question. And our question is ending on information 9. So this is what we, so on the first part of our question, it requires us to calculate depreciation on equipment on 29th February 2024, which is at the end of the financial year. So we try to see what we are given in terms of equipment, but if you come, you'd see that according to the balance is given in the trial balance, in the list of balance that we are given there, we see that for equipment, you are given accumulated depreciation on equipment at the beginning, which is 344,700. And also we are given accumulated depreciation at the end, which is 472,500. So we can easily find the depreciation for the period, whereby we are saying the depreciation, accumulated depreciation balance at the end minus accumulated depreciation balance that we have at the beginning. So we are saying 472,500, and then we subtract 344,700. That is on the first part. So going to our answer section, we'd say that this is going to be our answer section, whereby on the depreciation of equipment, we are saying uh, 472,500 is given here minus 344,700. So with that, we can get the depreciation for the year, which is going to be 127,800. So that is what we want the first part. So moving on to the second part, um, we are given it as a calculation of the cost price of vehicles on 29th February 2024. Cost price of vehicles on 29th February 2024. So if you come here, you see that the vehicle, it costs at the end, we are not given, but we are given the cost at the beginning. So we go to additional information to the uh, fixed assets information. So we need to find the movements in terms of the vehicles, what vehicles were bought and what vehicles were disposed, so that we can able to see. But if you look there, that there's an old vehicle traded in on September 2023 for a new vehicle costing 320,000 rands. So we've got a vehicle that is coming in, which is going to be a plus of 320,000 rands. Then the trade-in value received was 153,760 rands. We are not concerned about that one. Following extract of the vehicle sold was taken from the fixed asset register. So this is the fixed asset register showing at the traded in vehicle. So it had cost price of 240,000. Remember, we want to calculate the cost price. So this one is going out, so it's going to be a negative. So basically, that's what we have on that part. So it means we are going to say the cost price that we have at the beginning, then we add our 320, then we subtract our 240,000. So basically, if we refer back there, you're going to see that the costs that we have at the beginning of vehicles is 1,250,000. So in our answer section, we are saying 1,250,000. And then we subtract the one that is going out, which is the one that is going out is 240,000. The one that is being traded in is 240,000. So we subtract it. So we add the one that is coming in, which is 320,000. Then we calculate it like that, where we're saying 1,250,000 minus 240,000 plus 320,000. And then the answer that you're supposed to get is 1,330,000. 1,330,000 becomes the correct response that we have. So this is the answer that we have. So as well, we can try to calculate that one. Well, the next question requires us to calculate depletion on vehicles on 29 February 2024. So we check in terms of the fixed assets information that we have, whereby vehicles, that's when we have got an old vehicle which was traded in on 1 September 2023 for a new vehicle costing 320,000. So we've got a new vehicles which came on 1 September 2023. So we can calculate depreciation for that one. But you see that our vehicles are depreciated at 20% is indicated here, 20% per annum on the diminishing balance method. So remember the diminishing balance method formula, we say percentage times our carrying value. So remember our carrying value, we would have got our carrying value is equal to our cost minus accumulated depreciation. So in this case, we are going to just use the cost because we are this is a new vehicle that is not depreciated yet. So you can just say 20% of 320,000. Then you're going to make the proportionate number of months that this vehicle stayed in the business. It came in 1 September. And if you refer back at the beginning of the question, you see that our year is ended 29 February 2024. And this one came in 1 September 2023. So we are saying the whole of September, October, November, December, January, February. So we have 1, 2, 3, 4, 5, 6. We have got 6 months that we have. So we are going to multiply by 6 over 12 after we have calculated the annual depreciation, because this 20% is per annum, which is for 12 months. So when you're now making a proportion of 6 months, you're just going to say times 6 over 12. So in this case, if you go to our answer section, we have that section for depreciation on a new vehicle, whereby we are going to say 0.2, which is our 20%. 0.2, which is our 20%. Remember, 20% is 20 over 100, and then we multiply by 320,000. 20 over 100, then we multiply by 320,000. Remember, we make a proportionate of 6 months as indicated. So we calculate it like that. We see that the answer that we are going to get is 32,000. So we have 32,000. So this is our tree for that part. Then we've got depreciation on vehicle traded in. Depreciation on a vehicle traded in. So if you refer back there, you'll see that the traded in vehicle is the one that is given at this table here, whereby we have the depreciation and then we've got the accumulated depreciation. So we check in terms of what we have, because this it has information of the year ended 28 February 2022 and information of year ended 28 February 2023, and then in the recent year is where we are now, where it only was there up to 1 September 2023. So this is the depreciation that we want. It's using the diminishing balance method, which is a percentage times cost. So we have to find the carrying value first. Uh, Percentage times carrying value, sorry, diminishing balance method, which uses a percentage times carrying value, where the carrying value is equals to cost minus accumulated depreciation. So we have to find the carrying value first. Whereby the carrying value, we are going to say the costs, the cost minus the accumulated depreciation that we have at the end of which is at the year end of 28 February 2023. So we're going to say 240,000, and then we subtract 73,600. The answer that we get is the carrying value, and then we multiply by 0.2, which is about 20%, to get the depreciation for the year. So when we have done that, we are supposed to multiply again by 6/12, because this traded in vehicle stayed for 6 months. Remember, it stayed um, from the end of 20 February 2023, that is from 1 March 2023 up to 1 September. So you're saying the whole of March, April, May, June, July, August, and then 1 September, that's when it was traded in. So we've got 1, 2, 3, 4, 5, 6. So we have got six months. So the answer that we get, we multiply by 6/12. So we come here, we present it as such, whereby we are saying 20%, which is 20/100, and then we multiply by the difference to get the carrying value, whereby we said it's 240,000 minus 73,600. Then we subtract to 73,600. And then the answer that we get will be in annual depreciation. So we need to make the proportional number of months, which is 6/12. So we calculate like that, so that the answer that you're going to get is 16,640. So to get the total depreciation on the vehicles, we now add the 32,000 plus 16,640 plus 132,720. So we've got depreciation on remaining vehicles, which we can try to relate according to the information given, whereby we are said told that depreciation on the old remaining vehicles was 132,720, which is the one that is pre-entered here. So we add the 3 to get the total, which is going to be 181,360. Then on 1.1.4, a profit or loss on a vehicle traded in on 1 September 2023. So to get the profit or loss, remember you have to come up with a disposal account. So we have your disposal, where we have the costs on the debit side, and accumulated depreciation comes on the credit side, and then the proceeds on the disposal will come on the credit side. Then we compare to see which side is greater. So if we have got a smaller figure on the credit side, that means that where we've got the balancing figure, that's where it means it's a loss on disposal. But if the smaller figure is on the debit side, it means the balancing figure should come on the debit. It becomes profit on disposal. So depending on where we have the balancing figure. So this is what we have. So we check in terms of what we have according to this question concerning these elements, whereby if we refer back, we would see that the costs of the the traded in vehicle is the one that we are assuming is disposed. So it had a cost of 240,000. So if we come here, we are saying the cost is 240,000. And if you check in terms of the other information given, accumulated depreciation is now 73,600 plus the one for the period that we calculated here, plus this one, 16,640 plus 16,640. Then we get the total. So if you add the two, see that the total that we are supposed to get. So you get 90,240. 90,240. So this 90,240 is now the accumulated depreciation figure which we are supposed to show on the credit side. So we have 90,240. And then in terms of the proceeds, what were the proceeds? We're given the proceeds is 153,660 here. So it's the one that is supposed to come here. So we see which side is greater. So if you look on the debit, we've got 240,000, then on the credit, we say 90,240, and then you add your 153,660, you're going to get it as 240. You're going to get it as 243,900. So the total that we have on the credit is greater. So it means we've got a balancing figure that we have on the debit side. So on the balancing figure, we are now saying the total of these two figures, which is 243,900, and then we subtract 240,000. You get 3,900, which is supposed to be the profit. So basically, this is the profit that we have. So that is exactly what we are going to just to summarize, other section whereby we are going to say 90,240. And then we add 153,660, which is this figure that we have. Then we subtract 240,000. And we get your profit on disposal is 3,900. So this is what we have on that part. Then we move on to the next part of our question, which is now needs us to complete the statement of comprehensive income for the year ended 29 February 2024. Some amounts are provided in the answer book. So I will go to the answer section in terms of the statement of comprehensive income, whereby we have this part. So the cost of sales is pre-entered as 4,780,900. So in terms of our sales, we need to calculate it according to information given in additional information, obviously. So we would want to see what do we have in terms of that information that will lead us to our sales. So if you come on item 2, item 2 is the company maintains a markup of 60% on cost. Note that goods costing 115,000 rands included in the cost of sales were sold at a markup of 40% on costs to employees. So we see that we have got goods costing 115,000 that are inside our cost of sales that were not sold on markup of 60%, but they are sold on markup of 40%. So to make it simpler, you can just separate them. The goods that has got a markup of 60% and the ones that has got a markup of 40% separately. So we'd see that the total of the cost of sales that we have is 4,780,900. So we are saying 4,780,900. That is the total cost of sales. So then we remove the cost of sales with a different markup, 115,000. So we calculate them like that, see what do we get. So if you calculate like that, you see that the answer that you're going to get is 4,665,900. So with that, we are now having two groups of cost of goods, cost of sales, which we can now convert to our sales so that we get a figure for sales. So remember, these ones are using the markup of 60%. And the ones that are using 40% are these ones, 115,000. So we calculate them separately, whereby we are going to say our for the 4,780,900, remember the representation in terms of our markup of 60% is 100% plus 60% will give us 160% as our sales. And this is the cost of sales. And this becomes the markup. And we are saying the figure that we are given here is our cost of sales, which is 4,780,000, 4,600. We use the one after we have subtracted the one with 40% markup. So we are using 4,665,900. So that's 100%. Then the one that we are looking for is 160%, which is the sales representation. So what we are going to do is we are going to say the 160 becomes the numerator. The 160 becomes the numerator, and then the 100% for the cost of sales becomes the denominator, and then we multiply by 4,665,900. So we are going to summarize that now here in our answer section, whereby we are saying 160 over 100, and then we multiply by 4,665,900. And the answer that we get, we add it to the second group of our cost of sales, which is we also do the same. This one is now not using 160, but remember the markup of the second group of we have got 40%, which is which has a cost of sales of 115,000. So basically, what we are saying is we are also saying 100% plus 40% equal to 140. So our sales that we want to find is 140. Then the 115,000 is the 100%. So we say 140 over 100. So we come here. So we are going to say 140 over 100, and then we multiply by 115,000. So obviously we calculate to see what do we get there. So let's just try to calculate. So on the first part, if you calculate here, you're going to get your answer is 7,465,440. And then we add it to the answer on the second part, whereby you are supposed to get 161,000. So you get the two, you are supposed to get your final answer is 7,626,440. So it means we can now find our gross profit by saying our sales minus cost of sales. So if you subtract the gross profit figure that you're supposed to get, it's 2,845,540. So basically that's what we have on that part. Then we now have a pre-entered figure under income, whereby we got service fee income 1,757,700 is pre-entered. So we look for other incomes that we have in the question and that we can go through. So if we go to the list that we are given, you'll see that we check for other incomes. A service fee, we've identified it. It is already pre-entered. So we look for the other pre-entered. We look for the other items that we have there. So remember, we also calculated the profit, the profit on disposal on vehicles that we calculated is 3,900. It's also under that section. So we have got the profit income that we have, that is the profit on sale of assets. So here we are saying so we sold vehicles, and the answer that we got was 3,900, which is exactly as indicated here as our profit on vehicle on disposal of vehicle. So moving on to another income that we can try to identify, you'd see that we have got also rent income, which is here 158,100. 158,100. So we go to additional information to see what do we have in terms of rent income. So if you come to additional information number 6, the tenant is renting on an office from Avro Park Limited. Rent for this office has been received and up until 30 April 2024. Rent was decreased by 8% on 1 December 2023 on the office rented. So this is what we have. So let's count the number of months that we have before the decrease. That is, remember, our year is starting 1 March 2023, 1 March 2023. That's where our year is starting. So from 1 March 2023 to 1 December 2023, that's when it was decreased. So we are saying the whole of March, April, May, June, July, August, September, October, November. Then 1 December it decreased. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9. So we have 9 months when it was not decreased. So after the decrease, it's now from 1 December. So we've got December, January, February. Then the year ended, but then the rate was received up to until 30 April. So we have also March and April. So we've got 1, 2, 3, 4, 5. So we've got 5 months that we have. That is after the decrease, including the 2 months that are outside the current financial period. Remember, they received up to 30 April, of which March and April are outside our financial period. So we need to find that rent that is outside the current period, and then we remove it. So basically, that's what we have. So according to the rent, when it decreased, it was now 8% less. So remember, before it decreased, it was 100%. It was 100%, and then it decreased by 8%, which means it went down to 92%. So 92%, we divide 92% by 100, it becomes 0.92. So it was now 0.92. So it was 0.92 for 5 months. So we are saying 5 times 0.92, and to see what we get there. Then we get 4.6. So 4.6 was after the decrease. And then before the decrease, we have got 9. It was 100%. So to get the total for the 14 months, including March and April, we're now saying 9 plus 4.6. And then you get your 13.6. So this is the total 13.6. That is representing the total rent income that we have here, which is 158,100. So we are saying 13.6 is equals to 158,100 here. So the one that we are looking for is the two extra, which is for March and April 2024, which are the months that are outside the current financial period. So remember, we are saying our year is ending February 2024, but we have got March and April that are also received. So for those 2 months, the rent was already decreased. It was 0.92. So 0.92 times 2, we find that the figure that we get there, we're going to get a 1.84. So it means it's 1.84. So the 1.84 is the one that we want to find. So we make now a proportion. So we've got 1.84. So basically that's what we have. This is a question mark. So we make a simple proportion by saying what we don't have is 1.84. And then we divide by 13.6, multiply by 158,100. We get the rent for those 2 months that were received in advance. And remember, we need to subtract that part. So 1.84, we divide by 13.6. We multiply by 158,100. We are going to get your rent is 21,390. So it becomes 21,390. So this 21,390 is the one that we need to subtract from 158,100 to get the net rent figure. So we come here, we are saying rent income. We are saying 158,100 minus 21,390. And then the answer that we were supposed to get there after we have subtracted, we can just try to use our calculators. You get 136,710. So that's what we have on that part of our rent income. So we'll move on to and check in terms of the next other income that we have in the question. So if you come to additional information number 4, it reads a provision for bad debts must be adjusted to 5% of the outstanding data. So take note, and we check in the additional information. We do not have any further bad debts that are mentioned in the additional information. Remember, if you've got any further bad debts that are mentioned in the additional information, we need to first subtract them from the figure for the data's control to get the net figure, then we multiply it by 5%. So in this case, we do not have. So we pick the figure that we have for data's control, which is 516,600. So we multiply it by 5% as indicated, which 5% is 0.05 as a decimal, and then we multiply by 516,600. So we multiply and see what we get there. You get your answer is 25,830. So this 25,830, we compare it with the level of provision for bad debts for the previous periods, which you are given here in the list that we have, whereby they give us as 29,520. So it means there's a movement that we have from 29,520 to 25,830. So we see that there's a decrease. So whenever there's a decrease, it will be under other income. But if it's an increase, we have to regard it as an expense. So with that now, we can calculate the difference between the two, which is going to be the decrease. In our answer section, we come here, we say provision for bad debts adjustment. Provision for bad debts adjustment. So with the figures that we have, remember we said 29,520 minus 25,830. Then you get your answer as 3,690. So 3,690 becomes the decrease that we need to include as the provision for bad debts adjustment. So we go to our answer section and we put up 3,690. So basically that's what we have on that one. Then from there, we can see that we've included all the other income that we have according to the question. You can as well try to verify by going through again the information that you have. So if you go to extra information, you can check if you've got any further other income that is given in the question. But you're going to see that we no longer have any. So in that case, we add to get the total for other income, whereby we say 1,757,700 plus 3,900 plus 136,710 plus 3,690. And then we get the total that is supposed to come here as 1,902,000. And you are supposed to say gross profit plus other income, then you get the gross operating income. Add these two, you get your gross operating income, which is supposed to come in, which in this case will be 4,747,540. So that's what we have for that part. Then we go to the operating expenses section, where obviously the total is going to come here of operating expenses, but we've got three pre-entered operating expenses in terms of audit fees, standard operating expenses, and bad debts. So we are going to list other expenses that we have in the question that we can find in the list of balances is given here. So if you come here, you'd see that we've got the list that is here, that we can go down checking for those expenses. So going down, you'd see that we are seeing that we have got for audit fees, but they are pre-entered. We've got standard operating expenses, they are pre-ended, bed tests, they are pre-ended. So we've got packing materials one that we are going to look at. So packing materials are 66,550 indicates packing material that was purchased. So the one that we need to put in the statement of comprehensive income as expense is the packing material that was used. So we can find that by saying what was purchased minus what is remaining at the end of the period. So we see what the additional information is saying. So if you go to item 3, you'd see that item 3 is telling us on point number 2, packing material used during the year, 58,700. So this one is an already calculated figure. So we can take that as an expense because they are saying it's packing materials used. But if we were given the stock of packing material at the end, we're supposed to subtract them from the figure that we have in the list of balance to get the one that is used. So here we are given it as used, 58,700. So we go ahead and include that. We say packing materials. And the figure that we have is 58,700. Then we check in terms of the next expense. We've got salaries and wages, including contributions, 1,425,600. So if you go to additional information and terms of adjustments of salaries, we come to additional information number 7. One employee was omitted from the salaries journal of February 2024. His net monthly salary was 19,340 after 35% deductions were made for his pension and personal tax, and 2,500 are deducted for medical aid. So the employer contributes 10% of his gross salary on behalf of employees towards pension. So you'd see that we are given that the net monthly salary after deductions 19,340. But we want the salary before the deductions. Obviously, this is going to be the gross that we need to add since it was omitted. So to get that now, but we are told that this was a figure after 35% deductions were made for his pension and personal tax. And also 2,500 was deducted, which is not part of the 35%. So it means we have to add back the 2,500. Then we see that the remaining part will be now 35%. So we say 19,340, then we add 2,500. You see what do we get there? You get 21,840. So 21,840 indicates now the other part besides 35%. So if you say this proportionate percentage of 21,840 plus 35% will get you 100%. So in other words, we are saying the representation of our 21,840 is 100 minus 35, which we are going to get as 65. So to get the gross now, which is now going to be the gross is going to be the 100%. We can just say is indicated. It means now this one is 65%, but the one that we need is 100%. So it's just proportionate calculation whereby we say 100 over 65 times 21,840. As simple as that. When you calculate, see what do we get there. Then we are going to get it as 33,600. So we have 33,600 as the gross. So we're supposed to add this 33,600 to the salary amount that we're given is 1,425,600. So we are saying salaries and wages, and we are saying we have got the ones that we have is in the list is 1,425,600. And then we add the one that we have calculated 33,600 as the gross salary, which was omitted. And then from there, we are supposed to add the remaining, that is the employer's contributes 20% of his gross salary, 10%. So it's going to be 10% of 33,600, which is going to be 3,360. So here we add again 3,360. So we add there, the total that you're supposed to get is 1,462,560. 1,462,560. So that's what we have for the salaries. Then we'll move on to the next part. From our salaries, I'll go to insurance. We've got 100,800. Then we check what explanation do we have in terms of insurance. So if we check down on the monthly insurance, we go to item 5 is explaining about insurance. Monthly insurance premiums were fixed for the past 3 years and were paid up to 31 May 2024. So it means the premiums that we have in the list of balances are up to 31 May 2024. So we count the number of months that are outside of our recent financial period. Remember, our financial period is ending end of February. So we are saying March, April, May, and then they are paid up to 31 May. So we have got 3 months that are outside. So we're going to say 3 over 12 times the total insurance that we are given there to find the one that we need to remove, 100,800 times 100,800. So if you calculate there, you'd see that, so you say 100,800 times 3 over 12. So we can just make a correction in terms of our denominator. Remember, the total of months that we have got 12 normal months plus the 3 that are outside the recent financial period, which makes us, if you add 3, you see that our denominator should be 15. We have got 15 months that are inside our 100,800. So it means in terms of our denominator here, we are going to say 3 over 15. So we say 3 over 15 times 100,800. So if you calculate, you see that the answer that you are supposed to get is 20,160, which you are supposed to subtract because 20,160 is insurance for the months March, April, and May, which are outside the recent financial period. So we need to subtract it from 100,800. So we come, answer section. We are saying insurance. So we are saying 100,800 minus 20,160. And if you subtract, the answer that you're supposed to get is 80,640. Then we have rent income. We've adjusted this other income, and then we check for any other further expense. Interest income, remember, is adjusted after uh, operating profit. So we go to director's fees. We have a director's fees, which we are given as a question mark. So we check in terms of our director's fees. We obviously, in terms of our director's fees, it means we need to find them as if you are given them as a question mark. So for director's fees, we go to additional information to see what they are saying about director's fees. We now go to item and number, item number 8, where we have our directors' fees information. It says that the company had two directors who received a combined annual fee of 1,065,200 after their monthly fees were increased by 5,800 each on 1 August 2023. A third director joined the company on 1 November 2023 and received the same monthly fee as the other directors, uh, excluding the increase of 5,800 per month. So it means that the third director was going to receive the fee which does not have the increase of 5,800, which is just going to be the normal fee. But on the 1,065,200, it was for two directors, but it included an increase of 5,800. So we need to remove this 5,800 inside our 1,065,200 so that we have an even director's fees for each and every month. Then we can now be able to find for the third director that we need to add to this figure to get the total. So the number of months that we have for uh, the 5,800 period, it was from 1 August 2023. So we are saying the whole of August, September, October, November, December, January, and February. So it was received for 7 months. So we are going to multiply 7 months times 5,800. Get the director's fees, the increase for one director. So we say 7 times 5,800, and then you get your 40,600. So remember, there were two directors, so it means you're going to multiply by 2. There were two directors that received the increase. So we multiply by 2, and the total we subtract it from the 1,065,200. So it becomes 81,200. So we subtract this figure from 1,065,200, whereby we are saying 1,065,200. We subtract 81,200, and then the answer that we are supposed to get is going to be 984,000. So 984,000 is for the two directors without the increase of 5,800. We've removed the increase, so we can now be able to find the monthly fee now. So there were two directors for 12 months. So we've got 12 months, so we multiply by 2, you get 24. So if you divide by 24, you get the monthly without the increase. So 984,000, you divide by 24, you get 41,000. So what it means is before the increase, it was 45,000 per month in terms of the fee. So this is the one that is going to apply for the third director, which was there from 1 November, of which the director was there for November, December, January, and February. So, well, it was there for 4 months. So we now multiply 41,000 times 4, so that you get the total for 4 months that we need to add to the one that we have. So 41,000, we multiply by 4, you get 164,000. So the 164,000 is the one that we are supposed to add to 1,065,200 to get the total for director's fees. So here we are saying director's fees. So for director's fees, we are adding the 1,065,000, 200, and then we add the 164,000. So if you add the two, the total that you are supposed to get becomes 1,229,200. So that's what we have on the director's fees. Remember, we also have a depreciation, of which we already calculated that depreciation, whereby we have depreciation on equipment, on vehicles. We can just check a depreciation on vehicles. We got it as 181,360. And the depreciation on equipment is 127,800. So we're going to add this 127,800 to the total for vehicles to get the total depreciation. So in brackets, we are saying 127,800 plus 181,360. So basically, this is what we have. And then we try to check if you've got any other expense that we are supposed to include according to the expenses given in the list. So we are also supposed to check our trading stock. Remember, the figure that we are given in the list here, 654,500, indicates the book value of trading stock. So we compare it with the physical stock count figure that we are given in additional information is 647,100. So we see that 647,100 is less than the book value. So the physical stock count, if it's less than the book value, it becomes the trading stock deficit. So it's an expense. So you're supposed to say 654,500 minus 647,100. So here we present a such whereby we are saying trading stock deficit, which we can calculate as saying our 600, we can just check in terms of the figures that we have. 654,500 minus the fiscal stock on figure 647,100. Then we try to calculate that and see what we get, which is going to be 7,400. So remember, we also have the total for depreciation. It's not yet ended. We add 127,800 plus 181,360. You're supposed to get your answer is 309,160. So this is what we have on that part. So with that now, we can now be able to add all the expenses that we have in the box to get the total. So the total for expenses should come here as, if you try to add, you're going to see that the total that you are going to get is 3,371,340. And of course, we subtract it from the figure for gross operating income to get your operating profit here. So if you subtract the operating profit that you are supposed to get, it's 1,376,200. So that's what we have there. Then interest expense, we refer back to the list of balances. You'd see that we are given, let's just try to see. This is now interest income. So interest income, we are given it as a question mark. So it means we can find it as a balancing figure. So we can leave it blank. Then we'll come back to look for it. Then we've got profit for interest expense. We cannot find it since we don't have interest income, but we're given interest expense. So if you go down, you'll see that we are given net profit after tax. Then we go to extra information to check any hint that can give us the missing figures. But if you go to the last item that we have, item 9, net profit after tax 992,160 is the one that is pre-entered, was calculated after taking into account all the adjustments above. Income tax is calculated at 28% of our net profit. So basically what it means is this figure, remember to say, let's just try to show it in our answer section. Remember this figure that we have here, net profit before tax is represented as 100%. And then income tax depends on the question. In this case, we're given it as 28%. So if you subtract now income tax from net profit before tax, you get your net profit after tax, which in a representation of percentages will be now 72%. So we can just make some proportionate calculation there, whereby we are saying to get our income tax, we are going to say 28 over 72 times 992,160, so that we can get our income tax. So we can try to calculate it as such and see what we get. So you are going to get 385,840. So we have 385,840 here. Obviously, income tax, we subtract it. And then net profit before tax, we can now add the two. That is, we are saying 992,160 plus 385,840. Or alternatively, we can use these percentages whereby we are saying we are looking for 100%, which is here. We are saying 100 over 72 times 992,160. You are still going to find the same figure. So we can just try to calculate it as such. You're going to get 1,378,000. So here we've got 1,378,000. So basically, this is what we have on that part. And then now we can go up to see the missing figure. So to get profit before interest expense, we have to add our net profit before tax plus interest expense, and then we get this figure. In other words, we are saying 1,378,000 plus 149,400. And then we get our profit before interest expense. So profit before interest expense becomes 1,527,400. So from there, we can also find our interest income. Remember, to get our profit before interest expense, we are supposed to say operating profit plus interest income. Then we get your profit before interest expense. So now to get your interest income, we are finding the difference between the two. 1,527,400 minus 1,376,200. Then you get your figure for interest income, which is supposed to be 151,200. So basically, this is what we have, guys, according to this video on the preparation of the statement of comprehensive income. Hopefully, the video was helpful, and please let's not forget to subscribe and share. Let's meet again in the next video.